Okay, today we are going to talk about the Forex definition and the most important concept of trading that you have to be aware of them before you start your first trade or you place your first trade. We will go across some Forex market structure, the phenomenon of the Forex market, and those features that make this market very individual, Uh, and then we will see how Forex works and what are the advantages and maybe disadvantages of this market and all the things that you have to know before you place your first trade. And then we will get through that the where to start, the starting point, or the right spot. Then you can have a good vision about your trading journey, maybe in the Forex market and the whole financial markets. And please be aware that the education is the most important part of the trading in Forex, because anyone can learn to successfully trade, as it doesn't have anything to do with the good luck or chance only. We know we may be lucky sometimes or not, but the fundamental of the trading is something that we have to learn, and we need to think about what we want to do with our investment and how they will fit into our financial plan even before we place our first trade. And this is the mission of this series of webinars, to introduce you to the most important part of those features and fundamentals of trading in financial markets. Okay, let's start with the definition of Forex trading. As you may know, Forex exchange or Forex happens when we exchange currencies for each other, which means buying one currency and selling another. The interesting thing about the Forex trading is that you buy and sell currencies simultaneously or at the same time, and that's why we have all those trading instruments in pairs. You can buy or sell currencies to benefit from their appreciation or depreciation against each other, and you trade Forex whenever you buy a product in other currency or exchange cash to go on vacation. It's not just something on the online platform. The online platform is a new demonstration of Forex trading or foreign exchange. For example, if you want to go from for example, India to UK, you need to change your rupee to the pound, the sterling pound, which is the local currency in the actually Britain. So in that case, you have participated in the Forex market because you exchange your local money and then you go to UK, and then when you back, you need to exchange your pounds back to the rupee maybe. So this is the actual foreign exchange. Or when you go for shopping, buy, for example, some imported goods, like let's say a famous Suisse chocolate. In that case, a company has changed a local currency to a foreign currency to import those actually goods, let's say the Suisse chocolates from the Switzerland into for example, India. Okay, so in that case, it means when you are buying an imported good, you are going to pay to the company in your local currency as a rupee, and this pay is gonna settled as a payment that the company has done in, for example, Switzerland franc, to import this chocolate. So you can see yourself actually surrounded by this foreign exchange participation for your everyday shopping or vacation, or actually buying something on the internet, for using, for example, some accounts like a Netflix and everything. For example, when you are going to charge your account Netflix, they charge you in terms of US dollar, but they simultaneously and automatically they exchange your local money to the US dollar and pay the fee in terms of the US dollar. So in that case, you have participated also in the Forex market. So the concept of foreign exchange is exchange one currency for another simultaneously. And the most influential participants in the Forex market are the central banks and federal governments, with their major task of maintaining foreign reserve volumes and adjusting a monetary policy in order to meet certain economic goals. And after that, we have the commercial banks and money transfer companies, among the largest participants in this market as they conduct day-to-day operations on behalf of their clients. And then international and commercial companies are also involved in the Forex market, whether a business is selling to an international client or buying from an international supplier, as we mentioned in our example. It will often employ hedging strategies to reduce or completely eliminate the foreign exchange risk. Because, for example, when you keep your investment in the foreign country, in that case, you need some financial assets to mitigate and control your risk. And one of these very common, useful risk hedging financial assets are the foreign exchange, or let's say the foreign currencies. And last but not least are the speculators, among the third level here, who attempt to make money by taking advantage or fluctuating exchange rate levels. We should keep in mind that speculators can be large traders such as hedge funds and also small traders just like you and me. So all of these participants in the financial markets actually dominate the market in three levels. What is happening between the central banks and big banks? We mention it as the first level, or the actually bank transferring. This is the first level, or the head of the foreign exchange, that the central banks issue money and the big banks trade them off for their financial purposes, to keep the balance of the reserve currency, or to meet some fiscal or let's say monetary policies of their own country. At the second level, we have the companies and institutions that they are trading those foreign currencies for the commercial purposes, or some brokers that they are trying to connect the retail traders who don't have access to the banks directly, connect them to the big bank and to the live market, like Inveslo, for example. That at this second level is trying to provide online services to those who don't have direct access to the big banks. And then at the third level, we have those speculators and all retail traders like us, like actually you and me, that we are going to trade in financial market. And the main purpose of trading Forex for speculators is making money on the price fluctuations, on the differentiation of the price. We want to buy actually low and sell high. This is the whole purpose of trading for the speculators. But the companies, as I mentioned, they usually use it in a different ways to hedge their foreign assets, to make some deals with the foreign companies or the foreign countries, to import or export goods and services. So any term of exchanging foreign currencies which for each other can be actually included somehow in the Forex market. So the next thing that worth to mention in Forex trading is that what you can trade in Forex. Financial markets are the largest market in the world, and the thing that we can trade in financial markets, we call them trading instruments. So they are the instruments that make us able to exchange some many things, many different goods and services, and other let's say the financial contracts and everything. We can trade them, and the financial market is a way to trade everything for each other. And for that, we need to put them into a financial contracts that we call them the financial instruments. So this is what we can trade in Forex. But the financial instruments can categorize as below, as you can see here on my presentation, that, for example, we can have the currencies for each other. We can trade currencies for each other, euro against the dollar, US dollar, or the for example, Japanese yen against the British pound, Okay, we can exchange those currencies for each other. Also, we can trade commodities, which are those industrial metals and or some agricultural products and some energy products like gas and oil, or some agricultural products like the wheat or corn or coffee. And to trade them, we can put them on the financial markets. And the other one that we mentioned here is the spot metals like gold and silver. You can trade gold and silver and all of those the precious metals physically. For example, you can go to a gold shop and find a nice, for example, a bracelet and buy it, okay, or a ring. Also, even a bullion. You can go to gold shop and buy a bullion. But when you buy a bullion, you have to be so careful about your asset because it's very precious, and you have to keep it safe in a safe place. Maybe you need an insurance on this, on your bullion, to be sure that you can keep your asset in a safe place under a safe regulation and scheme. And then you have to have some place to keep it. And all of these may cost you some money. You have to pay for insurance, you have to pay for a safe place, or you have to buy a safe. At the end of the day, add to the cost of the bullion that you paid, you need to cost maybe more. But financial markets give us the opportunity to keep the value of all of those assets that we wish to buy, but maybe we can't at the moment. For example, we can't buy a bullion of gold, but what about the uranium? We can't buy uranium. Or what about, for example, palladium or other precious metals? Or we can't buy them, by the way, because for most of the commodities and like the steels and other material, actually industrial metals, we need a proper storage for them. And for example, if we want to buy tons of steels, yeah, we need a proper storage to keep them there safe, out of the wind, out of the rain, someplace like that. But maybe we can't afford to have those storage or pay a rent to keep our physical metals there. In that case, financial markets enable us to have the value of all of those commodities like metals, soft commodities, energy commodities, and everything. We can trade them for money without any need to keep them physically. So this is the opportunity. Other than that, financial markets make us able to trade them as fast as possible. It means, for example, when you want to buy gold, you have to take some time. You have to go to the gold shop, and then you have to buy it. And when you want to sell it, you have to turn back to that gold shop maybe, or another gold shop, and you can sell it. Yes, but in financial markets, you can do it whenever and wherever you are and you want. For example, you can buy gold in a one and keep it only for 10 minutes, and then you can sell, or vice versa. Any other kind of the energy commodities or metals, like for example oil and gas, it's not possible for ordinary people to buy oil and keep it in their house or in the storage. They have to go to the regulated exchange, and they have to pass a lot of paperwork, and then they have to pay a minimum amount for, I guess, 1,000 barrels of oil. And they have to introduce a good storage to keep them safe, because they are inflammable, and you have to keep them out of any risk of the fire and everything. So it's not possible for us to buy and sell those. But in financial markets, we can trade the value of all of those commodities and spot metals. Also, we can trade the indices like S&P 500 and DAX 30. Also, we can trade the shares of the companies which are tradable only on the exchange markets. Exchange or the formal exchange is a place regulated by the certain authorities that if we want to trade those trading instruments, we have to uh, get certified by that exchange. But financial markets also have another option for us to trade them as the let's say the value of the contracts or the value of each share. In that case, you don't need to hold the share or buy the share. You just can buy and sell the value of the share. For example, you can buy or sell the Apple, Microsoft, Tesla, or in the better explanation, you are going to buy or sell the underlying the value of the underlying asset there. So this ability makes financial markets to expand and cover all around the tradable goods and tradable assets, even cryptocurrencies like Bitcoin. And there is a huge advantage to in trading cryptocurrencies on the Forex brokerage platform compared to those wallets, because when we know all that for example Bitcoin and the other actually cryptocurrencies are very safe. Okay, but what about the wallet? For example, if you forget your password of your wallet, you can't access to your cryptocurrency anymore, and you can't actually refine your password again. But when you are going to trade these cryptocurrencies on the Forex platform, as you are going to trade the value of the underlying crypto, not the physical crypto. It's not a physical crypto, but I mean actually the let's say the real crypto. You are going to trade the value of the crypto, so you can buy it and sell it much more faster than what you can do on your wallet. By the way, the exchange fees are so low when you buy and sell cryptos as the financial asset in Forex, not on the wallets. Also, at any moment, it is very safe because you know your broker, and at any moment that you forget or lost your or lose your password, you can refine it by asking your broker to reset your password, and then you will not actually lose the access to your own money. And by the way, this is it's a very safe compared to those wallets or exchange, let's say the those visual actually exchange that you can find on the internet to buy and sell the cryptos. So these are the list of the everything almost that you can trade on the Forex market. But it's not the only advantage of the Forex market. The other one is that the Forex market is working around the clock. The Forex market is run electronically via a global network of banks, so it has no central location, and trades can take place anywhere via a Forex broker of your choice. We call it the over-the-counter or ETC trading against to the exchange or formal exchange trading. What does it mean? It means, for example, when you want to buy a stock or you want to buy a car, yes, you have to go to the a car shop, or that actually auto shop, or that a representative of a brand needs to get some paperwork done before opening their shop. Okay, and for that, for example, if you know some shops near your home, but when you are in vacation, you don't have access to those shops. When you go from one city to another city, you may don't have access to those shops. But the Forex is the electronically global network of banks. It means to access to Forex market, to check the markets, you just need a stable internet connection. And just you need to register on a broker with your through the internet, and that's it. You can access to the market. So this is the fastest connection to a market around the world and historically, because there is nothing to cut your access to the market if you are in the vacation, if you are out of your country, if you don't have let's say some of your documents next to you at the moment. All of them can stop you accessing to the Forex market, because this is the OTC, as the electronically global network of banks. So you just need a stable internet connection. And another, as you see here on my presentation, another advantage of Forex market is that this market opens working. Actually, this market is working around the clock. It means you can trade Forex at any time, assuming it's during trading hours in any major Forex hubs: London, New York, Sydney, and Tokyo. As you can see here, for example, when trading starts at Sydney, it's the Sunday's night at 22, the local Sydney time. The local Sydney time is 8, but this is actually the UTC time, standard time. This is a 22 on the Sunday night, and then the trading starts there in Sydney and in New Zealand. And after that, 1 hour, depends on the winter or actually summer time. In Tokyo, the trading opens. The after forward of the Sydney is open. We call them together the Asian markets. Okay, so this is the Asian markets working 8 hours from the 22 on the started actually from the 22 of the Sunday till the 7 o'clock or 8 o'clock in the Monday morning UTC time. And then at the time that these Asian markets close, we see the London markets open at the 8 o'clock in the London, which is the just right at the UTC time standard. And they work 8 hours. By the way, before they close, we have New York market. We call it the European market. Till around the Europe, we see the markets can work from the 7:30, 8:30 through the 16 or 16:30. And by the way, when they're closed, we see the markets in the United States or the North America, all the Canada and the United States, have started to operate from 13 in the afternoon. And they are open till 22 OTC time. And at the 22, when they are closed, we see the Asian markets again actually start trading. So it means every moment around the clock, 24 hours per day, you can have some banks open someplace in the world. Yes. Sorry, I missed the question here from one of our attendees. Who decides the value of these assets, the assets that I mentioned in the previous slide? Who decides the value of these assets? The value of these assets determined in the broad market there. For example, when you want to trade the gold, okay, the value of the each bullion gold per or let's say the gold per ounce is determined in the gold market. So we assume that's a fair price for gold, and the only thing that we do in Forex is that we don't need to buy a physical gold if we think the gold is going actually to the price of the gold is going to rise. In that case, we can take benefits by buying the gold asset on Forex, which is a spot metal, a spot gold, as the CFD, okay, as a financial contract. So in that case, we don't need to hold the physical gold. We just can pay for the value of the gold, which is determined in the gold market. Or for example, the value of the wheat is determined in the wheat market. So Forex doesn't have anything with determination of values. No, all the values are determined in their own markets. And in Forex, we are just trying their price. I hope I could make it clear. Yes, so this is the reason that you have heard that the Forex is working around the clock, because when we are open in Sydney, the market start to operate till we close in New York, but at the moment, at that time, we see the other market, as for example, Asian market that starts the operation in the other side of the world. So we know these four markets as the market hubs because the major actually trading volume is included in these markets in Sydney, Tokyo, London, and New York. Yes, and let me check the question. We have another question from Mr. Varun. Is there any drawback of trading other metals like silver, platinum, besides gold? Yes, of course. Of course, depends on the broker of your choice. You can get access to as many as commodities which are tradable in the commodity market. It can be silver, it can be platinum. For example, on Inveslo, you can trade the gold and the silver as the spot metal, and also you can trade the gold not against the US dollar or based on the US dollar, also based on the euro. So this might be an advantage for those who think the value of the gold can be differ against the euro and against the dollar. So you can benefit from them from there as well. And also you can trade silver, yes. And for those energy commodities, you can also trade the oil and the spot oil as a spot commodity, and the natural gas. And also the two benchmark of oil is tradable, one from the Brent, which is based in London, and one from the WTI, which is based in New York, actually commodity market. Okay, great. Back to our present slide here. So why we, besides all of these actually advantages, or let's say the features of the Forex that I mentioned, because of the nature of this business, we have it around the clock, and also we can access it around the world and anywhere, anytime. And also we can trade plenty of different tradable or trading assets or instruments in the financial markets without holding there physically. So besides that, why Forex can be a good place to take benefits? First of all, because it's a decentralized market with no physical location, so you can have it around the world. And why that we mentioned, and this advantage makes the Forex the largest market in the whole world. The daily trading volume of Forex market exceeds the $6.6 trillion per day. And this is a number covers the entire global foreign exchange market. And the spot market, which is a part of the currency market relevant to most Forex traders, is a smaller, but it still is at 2 trillion per day. So you see, this is a very massive, considerable amount of money trading volume in the Forex market. It means the Forex is the most popular market globally. So because it works 24 hours, 5 days a week. And other than that, You can enter the forex market with the minimum deposit. For example, with Investlo, you can open your account with the $100 only. But if you want to trade gold on the physical, actually market, you need at least 1,000, let's say $920 to buy 1 ounce of gold. But in forex, you can just open an account with the $100, and you will be able to trade the gold, and you are able to take the same advantage as the one who put millions on gold from the price differentiation, because there is, let's say, there is a common discount for everyone. It doesn't mean that, for example, if you want to buy a house, yes, you have to go to the, for example, an agency. Housing markets will offer you a house at a minimum of only one flat, for example. But in that case, you may need $100,000 to buy a one flat, maybe in your country or here in Cyprus. You need at least $150,000 to buy a flat. So I can't, for example, participate in that market unless I have that amount of money. But when you put it on a forex market, you can enter the market with the minimum deposit of $100, and you can trade a part of the unit of each commodity or each financial asset in the market with your own minimum deposit. In the case of trading the financial assets, Forex offers a numbers of financial instruments as large as possible. As you see, you can trade all the metals, commodities, and cryptocurrencies and everything. And the very, very important advantage of Forex trading is that it comes in a very, very low transaction fee. It means, for example, in the physical market, you have to pay at least 1% or 0.5% on each trade. For example, when you buy a car or sell a car, or and you have to get a lot of paperwork done. But in Forex, you are going to pay 1,000 on, for example, on each dollar that you trade. For example, if you trade $100,000, you would need to pay less than $10 as a transaction fee. And you see, this is another actually advantage of the Forex market that makes it very attractive for many traders around the world. Okay, but all of these advantages don't mean that you can benefit from this market if you start right now. With all of these advantages, you still need to learn them, and you need to learn the concept of the trading concepts, or let's say the phenomenon of the market, to become a skillful trader, because it's a very risky market, it's a very fast market. So the first things to know in the market we are going through is, as much as actually we have time, the first thing to know is the base currency and code currency. To have a better understanding of Forex market, first we need to comprehend the trading essentials, and this is the first step. To do so, let's start with the basic of Forex trading. The Forex market involves buying or selling currencies pairs I mentioned, such as euro against USD, US dollar, or the British pound against the US dollar, or euro against the Japanese yen, or etc. And the first listed currency in a pair is referred to as the base currency. So you can find all the currencies quoted in pairs. Okay, so the first currency is the base currency, and the second listed currency is known as the quote currency or counter currency, as you see here. And the price is always quoted based on the quote currency. So, and the price of a pair is called, it's called the exchange rate, and which means the value of the base currency in terms of the quote currency. We also call it the market price. For example, when we see the euro USD is 1.13500, it means each euro equals to 1.13500 USD, or let's say the $1.13 and half a cent. The pairs are always quoted on the quote currency or the counter currency. I mean the second currency in a currency pair. So now when you see the fluctuation in the market, you see, for example, let me show you here on the MT4. The market watch is a place that you can find the currency and currency pairs. Okay, you see on the market watch you have always the pair of currencies or pair of instruments, for example AUD against the CHF, and you can see the price is fluctuating up and down, and each price, for example here I have the euro USD on my chart in a daily on a daily time frame. Yes, for example here you see this is a price, a quoted price. It means each euro values about $1.10. Okay, so this is the way that we quote the currencies. And when you see a price is going up, it means each euro is getting more expensive against the dollar. It means we have the appreciation of our base currency, which in this example is euro. And when we see the prices are actually going down, it means the value of euro is falling against the USD. Or on the other hand, put it simply, we can say the USD is appreciating against the euro. So it means, back to our presentation here, when I see the euro is strengthening against the dollar, I expect the price to go up. And when I guess or I think the euro is going to depreciate against the US dollar, I expect the price goes down. So this is the base currency and quote currency and the market price. Oh, by the way, changes in Forex prices are much smaller than changes in shares. Most currency pairs are quoted in 5 decimal points. For this reason, traders use a very tiny unit of measurement to express the change in value between two currencies. This smallest point of the movement is called a pip, which stands for point in price or percentage in point or price interest point. It doesn't matter what you call it, okay? A pip in Forex pair corresponds to a single digit movement in the 4th decimal point of price. For example, Euro USD moves up 1 pip if it moves from 1.13500 to 1.13510. So we quote all the currencies, most of them in 5 decimal points, and the 4th decimal points refers to as pip. So this is the definition of pip in Forex. But it's good to keep in mind that the currency pairs involving Japanese yen are an exception to this rule. These FX pairs are quoted in 3 decimal points only, and a pip is equivalent to a single digit move in the 2nd decimal point. As you see here, the 2nd decimal point refers to as pip. For those currencies involved Japanese yen there, they are quoted in only 3 digits after a decimal, after a point. Okay, for example, here in this example, if USD JPY moves from 112 0.051 to 112.161. It means we have it actually moved up 1 pip, and the price here is not right. I have there is a typo here, sorry guys. So this is the definition of pip in forex. But besides that, each pip movement in a forex price is merely worth a small amount, as you see. For this reason, forex is traditionally traded in large batches called lots, or exploit these tiny changes actually in value, because the 1 pip is really the tiny measurement for a price changes, and the fluctuation in forex market is too small or too short. In that case, traders, to get the most benefit from these price fluctuations, they traditionally trade them in large batches, and we call those batches as lots. There are 3 types of lots. As you see here, one standard lot is equal to 100,000 units of each currency, of base currency. Okay, there are also a mini lots and micro lots, as you see here, which represent 10,000 and only 1,000 units respectively. And brokers usually show trading quantities in lots. For example, on the MT4, when you're going to place a new order, and you click here, this window pops up and you see this is the volume. In this volume is in terms of lots, and you can trade as small as one macro lot, which represents the 1,000 units of your base currency. For example, here, when I choose the 0.01, it means I'm going to trade buy or sell the 1,000 euros against the USD. Okay, so this is the concept of lot in forex, that you can actually calculate the amount of money you're putting in each trade by being familiar with this concept, with the concept of lots. Okay, the most exciting part here, guys, is that the forex traders look to profit from fluctuations in the exchange rates of currency pairs. If there is evidence that the euro will strengthen against the dollar, as I mentioned before, traders might buy euro USD to capitalize on its rise. Okay, so basically, buying a currency pair means buying the base currency and selling the code currency at the same time. In this case, you want the base currency to rise in value, so that you can then sell it back at a higher price. It means when we are talking about the forex trading, we are talking about the buying and selling the value of the underlying assets, which can be anything, commodities, currencies, and anything. Okay, so this is the meaning of buying in forex markets. For example, if we look at the euro USD, traders wish to buy when the euro strengthens against the dollar. In that case, when you open a position on the MT4, as you see here on my chart, when you are going to open position on the MT4, you are going to open a buy position. It means you exchange, you find a chance to exchange. Here is my terminal. My balance is about the 1,000. Okay, it means when I think the euro is going to strengthen against the dollar, I can put my money in euro instead of the USD. It means I'm going to buy it right now with the wish of capitalize on its rise, on the rise of the value of euro. So it means I'm going to buy, to open a buy position, to exchange my balance to the base currency against the USD, or against the code currency, which here is the euro USD. Okay, and then when you open a buy position, at some point you need to close your position. And when you close your position in forex, it means you are changing back your money for example, from euro to USD again. And in that case, you can make some profit. So again, basically, buying a currency pair means buying the base currency and selling the code currency. It means you are going to exchange your money to the base currency for the actually code currency. In this case, you want the base currency to rise in value so that you can then sell it back at a higher price, as you see here. And also, or alternatively, if traders believe that the base currency which is euro here will weaken against the code currency, the dollar here, which is a dollar here, they can sell the pair and profits. It means, so selling in Forex, many people, this is a very confusing term for many people who are not familiar with Forex, because they ask, how can I sell something that I don't have? Okay, we are not going to do that. Buying and selling in Forex means exchanging the base for the code. Okay, so when you are going to sell, you means you wish the price of euro actually down. Okay, in that means that means you don't want to keep your money in euro. You want to exchange them to, for example, USD. In that case, you can sell the euro USD. It means exchange your euros to USD, exchange your base currency to the code currency. This is a meaning of sell position in Forex. You're not going to sell something that you don't have. Yes, you're going to exchange your money when you think the value of your money is gonna crash. And then you can buy it back when you think this is the end of a crash or the value is gonna be appreciated against the code currency. So by selling a currency pair, we mean selling the base currency and buying the code currency simultaneously. In this case, you want the base currency, which we have euro here, to fall in value so that you can then buy it back at the lower price. And this is known as going short or taking a short position. And this is a huge opportunity in Forex trading because it means you can take advantage of price fluctuations in any way, either going up or either going down. For example, if you hold some stock up, you can make profits when stocks crash. When you have some asset and you see the price of your asset is going down, you can't do anything to make profit. The only thing you can is just to sell and cut your losses. But in Forex, because we have all the instruments in pair, it means you can always change your money to that currency that is strengthening against the other one. If this is the base currency, which here, for example, Euro USD, if this is the base currency which is strengthening against the code currency, I'm going to buy this instrument, or I'm going to exchange my money to the base currency when I see the price is rising, for example, something like here. And when I see a market crash or I see the price is going down, I can exchange my base currency to the code currency, which means I can short sell. I can sell, or I can open a short position or sell position. It means I'm going to buy the currency that I think is strengthening, which here is the USD, the code currency. So I'm gonna to change my euros to USD to make benefit of this dropping. And this is how it works. This is how we can determine the buy and sells in Forex. Thank you so much. I hope to see you next time in our next webinar that we are going to discuss the more essentials in Forex trading, and we will take a look at the leverage, at the prices, and also at the many exciting concepts that you can take benefits from them in Forex trading. Thank you so much, and have a nice weekend. Bye-bye.